Saturday, November 24th, 2018, Monaco 64, home of alternative economics and contrarian views. This morning, I want to talk about several subjects. I want to look at the stock market first and the technicals. I want to look at the gold price, the Dow gold ratio, and the gold silver ratio. I'll look into cryptocurrencies as well and what I've been doing and what I think is going on with cryptocurrencies and the blockchain ecosystem in general. And then I want to talk about why it's so important still to have physical precious metals in your possession or stored safely outside the banking system as well. Why it's so important to have that kind of security or insurance against counterparty risk. So I'll start out with the charts right now. Had a very interesting week for the stock market. It was an abbreviated week with Thanksgiving. Yesterday was a half day in the stock market. We closed at 1 p.m. New York time. The Dow yesterday closed down 178 or 0.73% at 24,285. S&P 500 index closed down 17 or 0.66%, 2/3 of a percent. At 2632.56, and the Nasdaq Composite finished down 0.5% or down 33 points. And before I look at the charts of these indices, I'll just go over what they've been doing year to date, because significantly the Dow and the S&P are now down on the year. I know some of you don't think it's important to look at these kinds of statistics, but it does make a difference because a lot of investment managers, traders, it's important for them the year to date, and it affects the markets. So the Dow closed 24,285.95. It was at 25,031.03 in the previous week. So it was down 2.97% for the week. Year to date, though, the Dow is now down 1.75%. It closed 2017 at 24,719.22. So we're now down on the year. S&P was down almost 4% for the week, or 3.79%. Year to date is down about 1.53%. It closed 2017 or on the 29th of December at 2673.61, and yesterday we closed at 2632.56. The composite, the Nasdaq Composite, is still slightly up on the year. On the week it was down 4.26%. And it did kind of outperform a little bit on a relative basis towards the end of the week. Year to date, it's up 0.5%. So it closed on December 29th at 6,903.39. We're now at 6,938.98. So as you can see, things are getting, confidence in the paper assets is decreasing. Will be very interesting to see what happens next week, of course. And why do I think this is happening? Well, I made a video weeks ago, or maybe a month, I'm not sure exactly when, saying that you cannot fight the Fed either way when they're cutting or accommodative. Financial assets do well. And when they're like not accommodative, like they're now, when they're hiking rates, when they're selling off their balance sheet. And by selling off their balance sheet, the securities on their balance sheet, they take money out of the system because they sell it and they get whoever buys from the Fed needs to pay the Fed, and that the Fed takes that cash out of the system. And I think it's going to continue. I think the stock market is not out of the woods. Am I calling for a major collapse tomorrow or next week? No, I think no one really knows exactly how it's going to evolve, if it's going to take a month, 3 months, 1 year, 18 months. It's hard to say, but right now things are just heating up. I think we're, we're in the first few innings of this major correction. Let's quickly look at the charts. That's the Dow chart here. So we still have the 50-day moving average, the black line above the 100-day, which is the red line, and above the 200-day, which is the green line. But we have closed below that 200-day moving average this week. It was holding just above that 200-day, so that's not a good sign. We haven't seen the 50-day cross the 100-day yet, like we've seen in the S&P here, as you can see. And we're close to approaching the 200-day, the 50-day, that is, the black line. And that would be like what they call a death cross, when the 50 has crossed all, both 100 and 200. Yeah, not looking great, that chart. We've got like a double top as well, the high from the end of January and the recent high. I know it traded above that, but you could say this was a false breakout. NASDAQ is, the technical picture looks even worse, I would say, than the Dow and the S&P. We almost have a death cross here in the composite. The 50-day is getting very close to trading below the 200-day moving average, as you can see here. And we're way below all averages in terms of price. So not looking great, I would say, the stock market. Some people think, of course, we could have a Christmas rally. That's possible, but it could be from a lot lower levels. We still might have more work to do on the downside before we rally into the end of the year. So that's what I have to say about that. What about the Dow gold ratio? Well, I've been following that a little bit, and I've noticed that we had some support around 20. And all that means is the price of the Dow divided by the price of the troy ounce of gold. The recent low has been around just below 7 in 2011. I've made videos before of how we will know when the reset has happened. I think it is when the Dow gold ratio is near 1 or thereabouts. That will mean that the balance has been, how can I say, tilted more towards real assets. I think right now there's too much of a bubble, or there has been for many, many years or decades, in paper assets. And what they did in 08 was to try to save, the paper asset bubble by making it even bigger. And that's why I think we could even, that Dow gold ratio, it could even go below 0, which would mean that the ounce of gold is worth more than the Dow. At what price that will happen, I don't know. But right now in the short term, to me, it looks like, even though gold hasn't performed so well so far this year, we're still down on the year in dollars and other currencies. I think the direction is down in this ratio, so I think gold will continue to outperform financial assets going forward here. I think the next key technical level here is this 20 level, which are almost breaking, and 19 as well. So need to keep an eye on this. Silver, of course, has been caught in kind of the deleverage, deflationary, and by deflationary I don't mean negative CPI. I mean the paper markets and assets unwinding, the bubble unwind, because silver is considered also more of a industrial metal as well as a monetary metal. So we can see here that gold silver ratio is still very elevated. Yesterday, silver got hit hard and gold stayed quite steady, and that's why we're back above 85. Does that mean we can't go higher in this ratio. I mean, it's the highest it's been since the early 90s. Yes, we could go higher. That doesn't necessarily mean silver will go down. It could be that gold just outperforms. So I'm still holding on to my silver and gold, of course. What about the gold chart? Well, the gold chart is showing some interesting signs of turning, maybe more positive, especially if you look at the moving average here. The 50-day just crossed over the 100-day, which is encouraging. We're still far away from getting back above the 200-day moving average, which is around 1260 right now. Last week was an pretty interesting week. Gold actually didn't really do much. It stayed between 1220 and 1230. A bit of a range trading, but did well against the stock market. So that's the technical picture. Now quickly on cryptocurrencies. I saw a tweet about cryptocurrencies, and they had a picture of how the major tech stocks performed during the dot-com bubble when that burst in 01, 02. And they had Amazon and some other ones, and Amazon was down more than 90%. And I'm sure a lot of people never went back and bought that stock, and look what it's done since then. So that's how I think one should look right now at the cryptocurrencies. Are they all going to survive? No. That's why, as I always say, do your homework, pick the ones, the projects you like. What have I been doing? Have I been selling some of the cryptocurrencies that I have? No. I've actually can tell you that I added to EOS earlier this week, and this morning I actually bought some more Bitcoin. Not that much, but money that I can afford to not to have to access at the moment. That's the important thing about this as well. You need to manage your risk and your funds properly. You can't put money that you can't afford to, money that you might need to access as an emergency. You can't put that into any kind of speculation. You need to be careful and put only the amount of money that you can afford to leave there, because it's so volatile. You don't want to liquidate cryptocurrencies. In my opinion, I think the blockchain still has a future. And of course, I will segue into now counterparty risk, which is something I said I was going to talk about in the beginning of the video. And what is counterparty risk? Well, I recommend people watch The Big Short, which is a great movie about the '08 crisis. And it's mainly about traders and investors who made a fortune during the '08 crisis because they bet against the housing market. But at one point, they weren't going to get paid off, because all the counterparties that they traded against, because they had to trade over the counter with Wall Street investment banks. So if they're going to make billions in these trades, who was going to pay them? Well, it was the counterparty who wrote them or issued them the credit default swaps. But all those Wall Street banks were going bust. So here you had these guys, these traders, they made the right bet. They're supposed to get paid billions, but things weren't normal. There was a systemic crisis. The whole system almost imploded. And ironically, one of them who got paid, he bet on the fact that the system was rotten, that the people on Wall Street and the central banks and government were like colluding and helping each other out. But as I said, ironically, he got his billions because that taxpayer through the Congress and the Fed had to bail out these banks, and it was only because of the bailouts that he got paid, or these people got paid. They wouldn't have gotten paid because the counterparties they traded against, they were going to go bust. So I think people are more aware of this, and the next time there will be a crisis, I think it will be even bigger. And it's not only me talking, about how much bigger this crisis is going to be. You have people like Stanley Druckenmiller, who's one of the most successful hedge fund managers, saying that. You have even Jacob Rothschild saying that we've never experienced this kind of monetary policy ever from central banks. The printing money out of thin air, inflating their balance sheets. So I think in the next crisis, it doesn't matter if you make a right bet, as long as, if you make that bet against a counterparty, against a Wall Street bank or ETF, you're not going to get paid, because it's going to be such a horrific implosion. And I don't think there is any political will to bail these people out again. You'll be bailed in, which basically means the bank is going to take your money from your account. Whatever bet you make in the stock market through ETFs or derivatives, they're not going to be paid off, in my opinion. And that's why physical gold and physical silver is so important, because there is no counterparty. It's in your hand. Money that you think you have in the bank is not even yours legally. It's how can I say, it's an unsecured loan. Cryptocurrencies, I think, are the same as precious metals. They are risks. They don't have any counterparty risk, but they're digital. I prefer more traditional, prefer precious metals, but I think it's important to have exposure to the cryptocurrencies. But you have to make sure you have your own private wallet, because if you keep it with an exchange, there's counterparty risk there as well. Excuse me. So if you enjoyed this video, please make sure you hit the like button, share it far and wide. If you haven't subscribed to the channel yet, please do. You can also follow me on Steemit, DTube, and on Twitter. I wish you all a great weekend, and I'll talk to you later. Take care. Bye.